Gentlemen, it is good to have you on the program.
Good to be with you, Maria.
Thanks, Maria.
Mr. McTeer, let me kick this off with you. Tim Geithner calling for Congress to allow Treasury to have increased new powers to regulate non-bank financial companies like AIG. Would this oversight go a long way to preventing another AIG-type collapse, or do you think this should not happen?
Well, I guess the devil is always in the details, and I'm not sure how he would propose it working. There does seem to be some need for oversight that's not silo by silo, and I think the Treasury and possibly the Federal Reserve are the two candidates logically for that.
Brian, is the government giving too much away in this partnership as far as buying the toxic assets, leaving taxpayers more exposed than they should be? I want to get both of your thoughts on the plan to buy the toxic assets from the major banks.
Right. Well, look, if everybody makes a lot of money, I'm sure people will say, hey, they gave too much away. But if there's losses, then it'll be the other way. But let me just put it this way. I don't think it would have worked at any less than the leverage that we have today, because you have to entice these private sector companies in to invest. And with all the risks, especially the political risk today, you've got to have the payoff be pretty high.
What do you think, Mr. McTeer, as far as that plan announced yesterday to buy the toxic assets? How do you view it?
Well, I view it as a good additional tool in the toolkit. I think that something that hasn't got as much attention as it should, though, is the potential relaxation of mark-to-market rules, which can be every bit as helpful and work along with this. The key to this plan is whether the banks are going to be willing to sell at the prices that are offered, and they do now have possibly a better way of holding on to those assets if they need to.
So you think that the banks could choose to hold on to those assets?
Well, it doesn't do a bank any good to sell these assets at too low a price. They're better off holding on to them until the market recovers than they are to take a huge loss. So it depends on whether the price comes out anywhere close to their basis.
I was just going to say, I think Bob's absolutely right here with the potential for FASB to allow more cash flows to be used to value these assets. That's going to allow them to be lifted in terms of their value on banks' books, which means they're going to be less willing to sell into this new private-public partnership at a price that's going to provide really big returns. So we've got a couple of things here working, plus the Fed's really easy, flooding the system with money. When you put all three of those things together, it's no wonder we had that big day in the stock market yesterday.
Well, what I hear you both saying is that, you know, if a bank could hold on to their assets and sell them in a couple of years at better prices, that's what they're going to do. That really doesn't help the situation right now, does it? We're still going to have those toxic assets then, some of them anyway, on the books of the banks, unless there's just a massive appeal to the banks to actually unload them. And then they're going to be trying to raise capital so that they could pay back the TARP money. They're going to be deleveraging, and they're not going to be lending as much. So where are we then? Then it doesn't sound like you buy into this plan, Bob.
Potential losses are no worse than actual losses, and if they're forced to sell them at too low a price, they're just going to have to realize a very large loss, and that's no better than being able to hold on to them until they recover.
What would be a better
plan? A lot of these losses are not real. A lot of these losses are fictitious, caused by having to mark mortgage-backed securities down because of just a few mortgages.
And that's the interesting thing is we could use this money that they're proposing to buy these assets to start new banks and make new loans somewhere else. What we're really doing with this plan is trying to force banks to unload securities at prices that are lower than real value so that somebody else can gain. And that's really, I think where the problem lies. Now, there may be a bunch of transactions here, but if there are at very low prices, this is going to hurt banks too, because they're going to take losses to their capital accounts as well.
You know, do you have a better solution, Bob McTeer? Tell me how you would approach getting those assets off the books, or at a minimum, let's talk about really the ultimate goal here, and that is getting credit flowing through the system. If it's not, you know, attacking those toxic assets, how do you do it?
I'm not saying that I'm against this program, Maria. I'm just saying that if they had changed the mark-to-market rules earlier, we wouldn't even be here. And the fact that they may be changing them on around April the 2nd is every bit as important as this program. This program has incentives for investors, but it doesn't have much incentive for the banks holding the illiquid securities.
Right, and let me just add my 2 cents. I'm not totally opposed to this program either. The government has to propose something, but I do agree with Bob that mark-to-market's a major and important change, and that will be coming early April. But here's the thing: is if the banks do not any longer have to write down these losses because of distressed security prices, then they won't be eroding their capital base, and they will be able to get back into the lending game. There's lots of ways to get banks lending, but one of the key ones is to make certain that they aren't fearful of eroding their regulatory capital because of mark-to-market accounting.
So
both
should
of these
mark-to-market
plans do
accounting
that.
then go away? I mean, it sounds like that is one of the major issues here.
We operated without mark-to-market accounting from 1938 till 2007, roughly, and we did okay. We didn't have any panics. We didn't have any depressions. We certainly didn't have anything like we've had in the last 18 months. I think we could operate without it. I think it's a real damaging piece of regulation. I think it's hurting our banks.
Bob, you agree with that?
I do. However, I don't expect them to go that far, but if they just break the link between the marks and the regulatory capital, that will be a major improvement.
All right, gentlemen, great to have you on the program. We so appreciate your very important insights on this topic. Thank you, gentlemen. We'll see you soon. Maria.